Hey everyone, Greg Sarnman, Mission Advisory Group. Listen, this is going to be for the more technical minded of you, especially the DIY investors. And I just want to be able to prove our mettle a little bit in terms of what we look at. A lot of people can talk about stocks and equities. You know, that's plastered all over financial media, but that's really a smaller market in comparison to the bond market and the currency markets and derivatives markets. You really have to understand what's going on in a lot of different spaces so that you can get out of the mindset of just pure linearity and pure equity markets and understand how patterns emerge. So I'm going to break these down in other videos to talk about the nuts and bolts of them and why they're important. So this video is just going to list the things that we look at. So right off the top, and this happens every single morning, these are the things that we look at to figure out kind of where things are, where things stand, where things are going. Number one, where's the US dollar? What is the dollar doing? Is the dollar rising? Is it falling? Is it staying the same? Number two, what is the high yield option adjusted spread doing? HYOAS, as I call them, HYOAS. What is the high yield option adjusted spread doing? If it's blowing out to the upside, it means risk. If it's staying the same or coming in or declining, usually means that things are pretty stable. What is the TED spread doing? Okay, this is the difference between the 3-month T-bill, US Treasury bill, and LIBOR, okay? So if that spread is widening, it usually means that there's some danger or disruption on the horizon, and if it's staying stable or declining, it usually means that things are pretty stable. So we would look at the TED spread to see if that's gapping out to understand what kind of risk is being perceived in the market. Where is the 10-year yield? Okay, very important, because as we know of the inverse relationship of bonds and the perception of the safety trade, right? Are yields coming in on the 10-year or is the yield moving out? So remember that if yield is moving up, price is declining, okay? If price is increasing, yields are moving down. So it runs in opposites. It's a seesaw effect. If you're seeing yield go up in the 10-year bond, it usually means it's a risk-on situation. And if you see the 10-year yield declining or coming in, it's usually a risk-off situation or a safety trade. What is the MOVE doing? So MOVE, the MOVE index. The MOVE index is a measure of volatility of the long bond. So this would be the US Treasury bond arena out in that 20 to 30-year maturity range. So again, safety trade, what is the MOVE index doing? How fast is it moving? What's the rate of change of the MOVE index? What is it telling you about the volatility of long bonds? That can determine where safety is being perceived, where risk on and risk off is being perceived in markets. What is gold doing? Okay, gold's another barometer. Is gold rising or falling? What are commodities doing? Are they rising and falling? That's going to be a good measure, at least in trend, in terms of inflation. And again, going back to the core thesis of our process and the institutional research that we subscribe to and how we manage our models, is that growth is either rising or falling. So it's either accelerating or decelerating at any given time. And inflation is either rising and falling. So it's either accelerating or decelerating at any given time. So we want to know what commodities are doing as well. Finally, onto the VIX. Where is the VIX, the volatility index? Is it rising or falling, and what has the trend been? So, you know, if the VIX is you know, at 8, 10, 12, or in the teens, you're talking about a pretty placid environment, really up until you know, almost 20. And then if the VIX is in kind of a 20 to 30 range, there's tradable. There's a tradable situation there. There's tradable chop in that 20 to 30. And if it's above 30, it's just hands off entirely. Like we just won't make trades or invest in anything when VIX is above 30. And that doesn't mean getting out of positions. It means that we might stay in positions, but it just means that we're not going into any positions when you've got a volatility index trading up at 30. Did the markets finish up or down on the prior day? And was volume up or down on the prior day? I mean, this could be very telling too, right? If markets are down, but volume is down, that's a more positive indicator. If markets are down and volume is up, that's a more negative indicator. Same works on the flip side. So were markets up or down yesterday, and what was volume doing on that day? Are the equities that you're looking at making higher highs? Are they making lower highs? Are they making higher lows, or are they making lower lows? Because this can establish a trend too. So if you think about if a particular stock or a particular stock index is setting lower highs, but it's also setting higher lows, that can mean consolidation. And usually if consolidation is occurring, you have this kind of period with a breakout from there. So really important to know, are you setting higher highs or lower highs? And then are you setting lower highs or lower lows or higher lows? Really important to understand what the trend looks like in that particular sector or index that you're looking at. And then taking it further, and this really gets into the process, the core of the process of what we do. Where is implied volatility relative to what you're looking at in equities? Is it a premium or a discount? If implied volatility is at a premium, that's a good signal for us. If implied volatility is at a discount, that's not a good signal for us in terms of how we run our process. And then what economic quad are we in? Are we in a quad 1, 2, 3, or 4? There's more information on our how to invest or how we invest part of our website. But the quads were invented by Hedgeye Risk Management. They were building upon the economic seasons theorem built by Bridgewater Associates and Ray Dalio, largest hedge fund in the world, who factored economic conditions down to 4 basic things, okay? Growth is either accelerating or decelerating, and inflation is either accelerating or decelerating. And you can put those on a quad map and back test all asset classes against it. So you got growth rising and inflation falling, growth rising and inflation rising, growth falling and inflation rising, which would be stagflation, and then growth falling along with deflation, which is market sell-off and recession. So we want to know what economic quadrant we're in at any given time and what the trend is. And furthermore, is it a steep, shallow, or deep situation? So we could be in a steep quad 2, for example, or we could be in a deep quad 4. We want to know whether it's a steep, deep, or shallow situation within those quads.